Happy Monday, everybody. Today is August 17th, 2026, and this is your Monday market update. Now, a big mazel tov to Micah and Nava, my son and new daughter-in-law, on their marriage last night. What a magical evening, and we're so excited for them. Let's go back into the markets. Last week was another one of those weeks where the headline numbers don't really tell the story. The S&P 500 finished the week slightly higher and actually set another all-time high along the way, but underneath the surface, investors were dealing with a lot. Inflation, interest rate, oil prices, continued uncertainty with Iran, the Strait of Hormuz, concerns about the consumer, and of course, the ongoing AI boom. So let's walk through what happened. Monday, relatively quiet start to the week, but geopolitical concerns quickly became the focus. Investors have been hoping for progress towards reopening the Strait of Hormuz, but when that progress failed to materialize, oil prices moved higher, treasury yields follow. That put some pressure on stocks, particularly technology shares. Intel fell after announcing plans to raise $15 billion through a stock offering, while Nvidia and Apple will also lower. At the closing bell, the Dow was down slightly, S&P was basically flat, and the Nasdaq was down about 0.25%. Tuesday brought another modest decline. Concerns about the Straits of Hormuz again continued. Oil prices moved higher. Technology stocks remained under pressure. Investors were also reluctant to make big moves with the July Consumer Price Index coming the next morning. The Dow and S&P both finished down about 0.25%, while the Nasdaq lost about 0.5%. Then came Wednesday and the first major economic report of the week, inflation. The July Consumer Price Index came in essentially right where economists expected. Headline inflation increased 0.1% for the month and 3.4% from a year ago. Core inflation, which excludes food and energy, rose 0.2% for the month and 2.5% year over year. Those numbers weren't dramatically better than expected, but importantly, they weren't worse either. Now, at the same time, enthusiasm surrounding artificial intelligence came roaring back. CoreWeave and Supermicro Computer both jumped roughly 19% following strong results and guidance, while Nebius surged more than 30%. The Dow finished essentially flat. S&P 500 gained about 0.25%, and the Nasdaq gained about 0.5%. Thursday brought even better inflation news. The producer price index was unchanged in July versus expectations for a 0.2% increase. Core producer prices rose 0.2%, also slightly better than expected. That was the second relatively friendly inflation report in 2 days, and investors responded by reducing expectations for a September Federal Reserve rate hike. Treasury yields fell and stocks moved to new records. The S&P 500 crossed 7,800 for the first time and closed at a record high. The Dow gained about 0.25%, S&P 500 gained about 0.75%, and the Nasdaq gained about 0.75%. Then Friday brought a reminder that good news on inflation doesn't necessarily mean everything in the economy is perfect. July retail sales unexpectedly fell 0.6% when economists had expected a slight increase. Even excluding autos, sales declined 0.3%. Consumer sentiment also weakened in August after improving in June and July. The University of Michigan Sentiment Index dropped to 51 from 55.2 in July, while one-year inflation expectations ticked higher. After Thursday's record-setting session, investors did a little profit-taking. The Dow, S&P 500, and Nasdaq all finished down about 0.25%. So where did that leave us for the week? Despite all the back and forth, S&P 500 managed its third consecutive positive week. For the full week, the Dow was down about 0.5%, S&P gained about 0.25%, and the Nasdaq was essentially flat. Small cap stocks actually had the strongest week, with the Russell 2000 gaining almost 1%. Now, I think the bigger story here is worth emphasizing. The market continues to balance the three competing narratives. First, inflation appears to be moving in the right direction again. That's important because just a few weeks ago, investors were becoming increasingly concerned that the Federal Reserve might have to raise interest rates again. Second, corporate earnings, particularly around artificial intelligence. Those earnings remain remarkably strong. That continues to provide fundamental support for stock prices. But third, we are starting to see some signs that the consumer and the broader economy may be slowing. Friday's retail sales report, combined with recent weaker employment and GDP data, means investors now have to ask a different question. We've spent a lot of time worrying about that the economy might be too strong and inflation might be too high. Now the question becomes, could the economy actually be slowing too much? That debate probably going to become increasingly important as we head towards Federal Reserve September meeting. Looking ahead this week, today we will get the Empire Manufacturing Index. Tomorrow is probably the busiest economic day of the week. We'll get July import prices, housing starts, building permits, industrial and manufacturing production, capacity utilization, and pending home sales. Import prices are going to be particularly important because they provide some of the remaining information economists need to estimate the Federal Reserve's preferred inflation measure, the core PCE. Wednesday will bring what could be the most most interesting event of the week, and that is the minutes from the Federal Reserve July meeting. Remember, three Fed presidents, Hamek, Kashkari, and Logan, they all dissented at that meeting and favored a quarter point rate hike. Investors will be looking closely at the minutes, excuse me, for clues about just how divided the Fed really is and what officials were thinking about inflation and the economy. Thursday, we'll get weekly jobless claims and the Philadelphia Fed Manufacturers Index, another important read on economic activity. And Friday, we'll get preliminary August manufacturing and services PMI reports. One interesting scheduling note this week, there are currently no scheduled Fed head speeches. So unlike many weeks, we won't have a parade of Fed officials potentially moving markets with every interview and speech. That means the economic data, and especially Wednesday's Fed minutes, should have a little more room to speak for themselves. As always, remember that 1 week, one inflation report, or even one employment report shouldn't determine your long-term investment strategy. Markets are sitting near record highs, valuations remain elevated, geopolitical uncertainty hasn't disappeared, and economic signals are becoming more mixed. But earnings remain strong, inflation has shown some improvement, and the market continues to demonstrate resilience. That's exactly why having a financial plan matters. We don't build portfolios around predicting what the next CPI report will say or whether the market will be higher or lower next Friday. We build them around your goals, your time horizon, and the things you actually can control. Have a great week, and we'll see you next Monday.